All right. Hello, and welcome to the Thanksgiving week edition of CAP STRAT this week. We've got some exciting, depending on the way you look at it, news to report. Certainly engaging news on the inflation front. We'll dive in there. But we'll start with market performance for the past week. We'll jump in with global equities and a whole lot of green. Yeah. And even some nice dark green here on this month-to-date column. It's been a strong and rapid rally.
Yeah, absolutely. And we talked about during last week's shoot, since November 1st, there's been a sequence of events that have led to the market getting more and more on board with the idea of a soft landing or an immaculate disinflation. Perhaps too on board with that narrative, which is something we'll unpack.
Yeah.
But what does that look like, getting on board with that? Well, it looks like last week, small caps up over 5%, now up 8% since November 1st. It looks like value stocks starting to catch a bid as well. You know, you look at this small cap outperformance, and the idea here is if we have this immaculate disinflation, you know, inflation comes down with no more weakness in the labor market and no recession, small caps have more room to run than large caps. You know, they're lower quality. They have lower quality balance sheets. They're much more likely to be unprofitable. They're much more likely to be saddled with higher interest costs if interest rates don't come down. All of those things, but they're selling at a huge discount to large caps. Yeah. Huge discount. So if you're looking for catch-up potential, that's where it is. Also, small caps were heavily shorted. I mean, they were down almost 20% from August 1st through October 31st. And over that time period, investors reducing exposure and shorting these names. And so you get a nice bounce back, all because of a little inflation, coolness in the inflation data.
Nice little coolness, and not to mention small caps, relatively speaking, you know, more exposed to the U.S. economy on a relative basis. And under this scenario that the market's pricing in, the U.S. economy is where the Fed is conducting monetary policy perfectly.
Yeah, right? Goldilocks. Absolutely.
The Goldilocks scenario.
And what's happening here in the U.S., inflation, you know, the inflation report last week coming in a little cooler than expected, and then the repricing of the Fed potentially cutting sooner, which we'll talk about later, that has implications for foreign currencies. And so we saw, if you look at these returns ex-US, a lot of that return comes from foreign currencies appreciating versus the dollar. Said differently, the dollar weakening, the dollar falling like a stone last week. So yes, plenty of reasons to be happy, as you're saying.
Yeah. It's all related to this Goldilocks scenario. What's the Fed going to do next, right?
Yep.
And so here, diving in a little bit deeper on the Magnificent Seven, the other 493, we've talked about this at length throughout the year. But some shifts in the underlying components here where, you know, a couple of months ago, we're talking about how it's the Magnificent Seven driving all of the return in the S&P 500. And then since November 1st, starting to see more of this everything rally. And now, lo and behold, the other 493 starting to pull their weight a little bit and contributing some positive return here year to date.
Yeah, absolutely. And that, you know, coincides with small caps rallying. The other thing to look at on this chart is it's often been said that markets are an escalator up and an elevator down. But if you think about the sell-off that we had from August 1st through October 31st, it was more like an escalator down and more like an elevator up since.
Yeah.
Going extreme mood shifts, right? At the end of October, looking at higher for longer, right? The Fed not cutting anytime soon, to with just a few data points and a few words by Jerome Powell at the November Fed meeting, to now the market almost fully pricing in this soft landing narrative, right? Yeah. Even those investors who share their viewpoints, who have been on board with a soft landing developing from the economy's perspective, look at the prices of assets after this rally we've had since November 1st and say, my Goldilocks scenario is virtually priced in now.
Yeah, right. Yeah.
Just extreme shifts in mindset, which to us says, you know, the truth is probably somewhere in the middle. You have to take a probabilistic view. The inflation fight is not over. We would not be fully pricing in a soft landing. You know, there's plenty more innings in this game.
Yeah,
right?
that's a couple of interesting things here. I mean, one is how quickly this has happened, which you alluded to, and two is, like you're saying, these kind of bullish forecasters that are now saying, okay, that's it, no more upside left based on my projections.
Yeah.
So
Right.
it has moved quickly, and it's not just stocks. It's
Right.
not just U.S. stocks, foreign stocks. It's fixed income as well. I mean, look at this month-to-date column since 11/1. Some notable green here, even in the Treasury space. I mean, you've got in the month of November the 30-year Treasury keeping up with large caps.
Mm-hmm.
So kind of that opposite scenario from what we saw a couple of months ago, where it was kind of a sell-off in everything, or prices falling everywhere. Now prices seem to be rising
everywhere. Yeah, and everything rally. And I mean, that's why investors have been so disappointed with diversification since 2022. I mean, correlations have been won. I mean, stocks rally because bonds are rallying. Bonds rally because stocks are rallying. And then if you look at the 2-year time period, it's red across the board in fixed income. It's red across the board in equities.
Right.
It's crazy to think if you go back to equities and you look at U.S. large caps down 27 basis points over the past 2 years, that's pretty much in line with a basket of short-term bonds, right? And if you own cash, you'd be better off. So the volatility, the difficult pricing in the end of the hiking cycle, will inflation be defeated? It keeps it interesting. Yeah, for sure.
Yeah, one area of the market that has continued to be a diversifier. Some good, some bad, but commodities still got some green over that 2-year time horizon, some red here in the month-to-date column. So seeing some of that, negative correlation relative to stocks in particular, but anything notable to hit on in the commodities or alternative space?
I mean, the energy space is notable, right? Down 8% or so month to date. A lot of that speaks to this Goldilocks economic data. The economic data has been coming in cooler than it was, but still sort of in line with expectations, right? But along with that, there's clearly been developments of, slowing demand for commodities. That's clear. And in the energy space, we're now talking about a potential, surplus of natural gas. Think about how far we've come from last summer. And this is where you see inflation ebbs and flows. There are forces in the market that start to push back on this disinflation. Now, if you look at Brent crude, we dipped below $80 a barrel. And so what happens then? Well, now OPEC Plus is meeting this weekend, and they're talking about potentially cutting production because they're not comfortable with that. So trying to push back up inflation, which we think once again speaks to this idea that there are plenty of more innings to go in this inflation fight. Let's not get carried away and price in one scenario too soon. Right?
Yeah. Don't declare victory just yet. But obviously, I mean, we've talked about it a bit here. I mean, a lot of this, the vast majority of this, in our opinion, being driven by that October inflation report. And so let's dive in there. Let's look at what the report was. Let's try to break down how we think the Fed is going to digest this information and what they may be looking for going forward. So headline, right? Inflation in October coming in lower than expected, and the market reaction being pretty significant to the upside for both equities and fixed income prices.
Yeah, and then the headline CPI month over month basically flat. That wasn't actually too far from expectations. That's not why the market rallied. It was on the core side. At this point, the Fed is reacting to core measures of inflation, particularly services. And that is what got the market excited, because the core CPI month over month came in around 0.2 versus expectations for around 0.3. And that was, we've only had a few CPI prints that have come in that much cooler than expected. The last time was back in June, and we know how that ended up, right? The Fed pushed back against that, higher for longer. We'll talk about that later. But so that was the big news, right? And you look at how that's impacted our CPI forecasts. Core CPI, we still expect going all the way out to October 2024, on a year-over-year basis, core CPI to be running 3.3, which is, too hot for the Fed's liking, right? That has come down a little bit, though. After the print last week, that's about 20 to 30 basis points lower than what we were previously expecting at the end of our forecast horizon. So, but the broader picture here is, if you've been in the business of forecasting inflation over the past 3 years, odds are you've been humbled multiple times. And the Fed is certainly in that boat. I mean, you look at how they spoke during Jackson Hole. They clearly are taking their inflation forecast with a grain of salt. At this point, what are they looking at? They're looking at core measures of inflation. And everybody knows if you look at core measures of inflation, the goods basket is in disinflation or deflationary territory. There, you could argue the game's over. You've won the war. You look at our PPI, I mean, and our forecast for PPI, it suggests that goods inflation is all but gone.
Yep.
You're worried about the services component of core inflation because that is most sensitive and requires the most labor. And you're worried about that re-accelerating
Wage
inflation
growth pressures, right?
from here,
Yep.
right? That's important. That's what you're worried about, and you're taking your forecast with a grain of salt, so you're looking at the actual trailing data and thinking, is inflation defeated? We talked about before, reactive rate cuts and proactive rate cuts,
Yep.
right? Every time in history, they've done reactive rate cuts, right? So we don't need to talk about that, but at this point, like, proactive rate cuts would be a shock,
Right.
They're probably going to be reactive, and it's going to be reacting to weaker than expected economic data, reacting to signs that the actual trailing inflation data is in line with their targets, 2.5%, or reacting to a banking crisis. That's where the cuts are going to come from. How far away are we from that? That's the question.
Right. So let's dive into the trailing economic inflation data here. And a little bit different to what we're accustomed to looking at. We're looking at a core CPI composite. Do you want to talk about exactly what the components are in these three lines here?
The Fed, when they're looking at core inflation, one, of course, they're looking at core CPI, but the other preferred measures of inflation they have are super core CPI, which is core, look at just the services component, and then strip out shelter, right? And then the other one is called the core sticky CPI. And that's provided by the Atlanta Fed, and what it does is look at historically all the different CPI components, which one of those components have sticky prices, meaning they take a long time to come down. That, in our view, is how the Fed's looking at inflation right now. They're looking at these measures of inflation, and they want to see evidence that they are all confirming inflation is defeated before they were to cut rates. They're taking their forecast with a grain of salt. And so we've averaged those three inflation measures, just for simplicity, and we have to look at them over different time periods. So in the green line, we have month over month, and then we annualize it.
Yep.
Purple line is the last 3 months annualized, and then we have the year over year in blue. And so the market got really excited about the green line. You take these three core CPI measures, you average them, up 3.24% month over month annualized. And so that's still well above target. In fact, it's above where we were in June.
Yep.
Right? So perhaps getting a bit carried away in terms of market pricing, and you highlighted there 2022, that was the last time, if you recall, mid-2022, where we got one good core inflation print. And the market rallied during July, almost erased all of its losses from earlier in 2022. And then all of that rally was undone when it turned out, we're only maybe in the second inning of this inflation fight, right? So that, if you look at the totality of the inflation data, how the Fed's looking at it, talks about rate cuts we think are premature, especially if you look at the 3 month. The 3 month has ticked up to 4.38% on an annualized rate. And that has to be very concerning. And the year over year is at 4.22. So when we look at the totality of the inflation data through the Fed's eyes, we would suggest they should not be leaning into the idea of rate cuts at all. This doesn't necessarily mean they need to do more hikes, but they should start to push back against the idea of rate cuts. Because if the market forecasts rate cuts and equities rally and bond yields come down, it will undermine their ability to defeat inflation. It could re-accelerate the economy and reignite inflation.
Right. So you kind of have these two sides, right? You have the market saying, green line, all good, inflation coming down, 3.2 is a heck of a lot better than what we've had recently, and we're good. The Fed won, everything's good to go. But then what we're thinking, maybe hoping, the Fed's reaction function is going to be, well, hang on a second, we've been here before.
Mm-hmm.
The market has tried to prematurely declare victory before. We don't want to fall into that trap again. And so I guess the question becomes, why exactly do we still think that that is appropriate from a Fed reaction standpoint? And why wouldn't they be looking at those proactive cuts that you say are so important, right?
Yeah. Yeah. Well, I think this sort of shows the journey they've been on, this chart. I mean, what you have here, the blue line is what the market is thinking in terms of rate hikes or cuts over the next 12 months. So you can see right now, the market is pricing in 0.61% of cuts.
Two and a half cuts.
A little more than 2 cuts. And you can see how much those rate cut expectations have built, since the end of October, or before we were expecting maybe 1 cut. So the market leaning into cuts. And the reason why we think the Fed would push back on that is because they're looking at financial conditions and economic surprises. Right, so we have those 2 indices. The economic surprise index in green, that measures if economic data is coming in generally stronger than expected or weaker than expected. It has been stronger than expected. You can see it's positive. And then that light blue area is the financial conditions index. So that measures in totality how tight or loose are financial conditions. If it's positive, financial conditions are loose, which means credit spreads are tight. It's easy to get financing. Equity markets are rallying, all these things. And the idea is, financial conditions are a leading indicator of economic growth and inflation. And so what you have is the market pricing in cuts, and that exuberance about rate cuts leading to a rally in stocks, leading to bond yields coming down, leading to credit spreads tightening, and then dramatically weakening financial conditions. The ebbs and the flows, right? So heading into that November 1st Fed meeting, financial conditions were very tight, right? And that's the main reason cited why the Fed felt confident they didn't have to hike in November. Well, now financial conditions are very loose.
Yeah.
And so as they go into December, that is why, in our view, they're going to be pushing back against the idea of imminent rate cuts. If these rate cuts start to get priced into Q1 2024, then they run the risk of reigniting inflation, and then the Fed has to then push back again and say higher for longer, or maybe even hike again, and they don't want to do that.
Yeah.
So in our view, based on this and how this whole inflation picture has evolved, the idea of these rate cuts is premature, and the Fed is going to throw cold water on them. Yeah. It's in their best interest to do so.
It's just amazing how far we've come and how quickly, to where in early mid-October, you're having conversations about the Fed doesn't need to hike even though they want to because financial conditions have been tightened for them.
Mm-hmm.
And now we're sitting here saying that financial conditions have loosened and the Fed should push back on that.
Yes.
The market has gone the other direction too strongly.
Right.
Yeah. All right. And so and from a Fed standpoint, particularly on the inflation front, they will have that November inflation data right around the time of their next meeting. So should be able to take that into account with the next monetary policy announcement.
Mm-hmm.
Awesome. Well, let's move into the remainder of our outlook components. We'll start with liquidity. So obviously talking about expectations around a rate cut being moved forward. How is that impacting our liquidity projections?
And whether or not the Fed starts cutting in June, or even if they were to cut in March, it's not going to make a huge difference in terms of liquidity. You can see, week over week, we've built potentially more cuts, out towards the end of our forecast horizon, and hasn't really moved the needle in terms of liquidity. And the other thing that doesn't really change here is the amount of debt that the Treasury is going to have to issue, which is going to suck liquidity away from the private sector and make it difficult to sustain above trend economic growth or anything like that. So liquidity hasn't moved all that much.
Sure. And then on the economic growth front, actual economic growth continuing to be a little bit better than expectations, maybe not by quite as wide of a margin as we saw mid-year. Any updates to our economic growth projections?
Thus far in Q4, the data it's no Q3, right? It's
tough to be.
Right. It's much cooler, but it's warm enough. It's very Goldilocks, right? And if you look at, GDP now type forecasts, they're tracking around 2, which is fine. Probably the retail sales last week wasn't really a game changer, but it pretty much came in line with expectations. Probably the biggest development was Congress kicked the can of a government shutdown down the road, another continuing resolution to the point where now they have to deal with this sometime in January. If they aren't able to resolve the situation in January, then potentially some discretionary spending cuts get baked in. So those were the big events for last week. Yeah.
Cool. And then we'll wrap up with our recession signal. As you may imagine, given some of the market rallies that we've been talking about, particularly the market stress signals really backing off from those trigger points, signal remains inactive. Anything to note here? Anything we should be looking at?
The yield curve got more inverted, and markets were less stressed about it.
Yep.
So good news. Doesn't look like we're going to head into a recession before Christmas.
That's great.
But we shoot weekly, so we'll see what we say next week.
We can update it as we go. Well, that brings us to the end of our video shoot here today. We certainly appreciate you tuning in and watching. Excited to have to answer any questions that may come in. If you have those, please send them along. And wanted to wish our viewers and all of their families a happy Thanksgiving. We're certainly grateful for our viewers and looking forward to talking to you next week.